I know. Okay, when we talk about stocks that, consistently seem to make money from almost every step inside a convenience store, the name TACC,
Yeah,
the in-cup beverage specialist, it just has to be on the list, right?
absolutely. It's a name that comes up a lot.
And in an era where, let's be honest, competition in the beverage market is fierce, TACC is doing more than just selling drinks. The business is actively expanding. We're talking character licensing, cosmetics, new international markets.
It's a broad strategy shift.
So the big questions are, how will TACC's Q368 financials actually perform? We need to look at those numbers. And, maybe more importantly, will the strategy to aggressively diversify away from relying so heavily on that single major customer, will that truly lead to a sustainable, maybe higher margin future?
That's the core issue, isn't it? Sustainability beyond the core partnership.
It really is. So today, we're diving deep into TACC Consumer. Hello, and welcome to the Deep Dive.
Great to be digging into this. Look, it's an essential analysis, and it really speaks to a critical trend we're seeing in the Thai capital market. The success of these specialized, high-efficiency manufacturers.
Definitely.
Now, a deep dive into TCC, it requires a bit of a nuanced approach, mostly because the financial data we have access to today focuses very heavily on a sector peer, Royal plus PCL, or Plialishi TB. They're highly effective, but geographically quite different from TCC.
Exactly, and that's key. Our source material gives us this incredibly detailed operational and financial blueprint for Pliel US. We aren't going to shy away from that. Actually, we're going to lean right into it.
Thanks.
We'll use this deep data on Pliel US as our primary proxy. It helps us establish sort of the high watermark for operational efficiency, how they manage profitability, global market positioning, all within this Thai beverage sector.
Right, think of PLUS as the template, almost. We can really understand how this export powerhouse manages risks, things like fluctuating raw material costs, customer concentration, which we know is an issue for TC2. Then we can set a pretty robust benchmark. And against that benchmark, we can then fully appreciate TCC's domestic strategies, its own unique risks, and ultimately why it commands that premium valuation relative to its peers like, say, ICHI and SAPE.
Okay, so our mission today is clear. We establish the sector baseline using PLUS, understand the global megatrends that are driving growth in this space, and then we transition those findings into a really comprehensive fundamental analysis of TCC's Q368 performance drivers and, crucially, that diversification strategy.
Sounds like a solid plan.
All right, let's unpack this. Let's set the stage first with the operational fundamentals of PLUS. So first things first, what exactly is the core identity of Royal Plus? I mean, we know they're in beverages, but they aren't the ones selling like milk tea in 7-Eleven, right?
No, not at all. PLUS is highly specialized. It's defined primarily as a manufacturer and, importantly, an exporter of high-quality fruit juices. And within that, there's an extremely heavy focus on coconut products, time in coconut water and coconut milk. This is not a domestic player in the way TCC is. It's fundamentally a global B2B supplier.
Right. And when you look at the 2021 numbers we have, that global focus, it's kind of overwhelming, isn't it?
It really is, statistically speaking. Based on that 2021 data, PLUS relies on export sales for a staggering 98.5% of its total sales revenue.
Wow, 98.5%.
Yeah, less than 2% of their business is focused on the domestic Thai market. So inherently, this means their entire operational structure, everything from sourcing raw materials to financing to logistics, it's all geared towards global demands and navigating those international shipping complexities.
Okay. And their business model, how does that break down? You mentioned B2B, so is it mostly OEM, original equipment manufacturer, versus, say, their own brands?
The volume is firmly, overwhelmingly on the OEM side. That means they manufacture private label products for major international customers. The customers then put their own brand name on the packaging.
Got it, the classic model.
Exactly. This high-volume B2B manufacturing accounted for, get this, 91.9% of their total sales back in 2021.
Okay, 91.9%. That's a powerhouse manufacturing model. So the remaining slice, about 8.1%, that comes from their own proprietary brands. Things like Coco Royal, Nita, Mabu, Sea Boom, Coco Cough, those names.
That's right. And the split, it highlights an inherent tension, doesn't it? It's something a lot of manufacturers grapple with.
How so?
Well, the OEM model provides massive, stable volume. It keeps the factory running, helps with capacity utilization, drives efficiency, but the margins are typically lower.
Right, no brand premium.
Exactly. They lack that brand premium.
Yeah.
So the long-term profitability goal, which we'll definitely talk more about later, is to push that 8.1% figure higher. leverage their own brands where they can capture those higher margins.
Makes sense. Okay, geographically, where is all this volume actually going? You said global, but where specifically?
The market is diversified, which is good, but there are clear concentration points. The U.S. remains the single largest market by far. It drives 43.0% of their total revenue.
Almost half from the U.S.
Yep. China is the second largest, significant but smaller, at 23.6%. And then beyond those two giants, they serve Europe, Latin America, the Middle East, and also the CLMV countries.
Right, CLMV. Just quickly for listeners who might not track these regional blocks closely, that's Cambodia, Laos, Myanmar, and Vietnam. Important, growing neighboring markets for Thailand.
Correct. Good clarification. So if we drill down even further into what they're actually selling, the focus is incredibly tight.
Okay.
Overall, 98.2% of their 2021 sales were classified just as fruit juice. But within that huge category, the coconut group, so coconut water and coconut milk combined, that accounts for over 70% of their total revenue.
Over 70% just from coconut products.
Yeah. They are, first and foremost, a coconut specialist. Things like general drinks, maybe milk tea or vitamin drinks, they're almost negligible in the mix, only about 1.8% of sales.
So it really feels like their fate rises and falls almost entirely with global coconut demand, which I guess leads us directly into this massive tailwind they seem to be riding, the global health megatrend.
Yeah. Exactly. Hashtag 1.2, the megatrend, and Thai coconut advantage. This is where their intense specialization really pays off immensely. The global shift, and it is a big shift towards health, towards functionality in beverages, towards plant-based alternatives. It's basically rocketed coconut products right into the spotlight.
Okay, but why specifically are they categorized as part of a health megatrend? I mean, why isn't coconut water just another soft drink?
That's a fair question. It's because they are internationally recognized and marketed as plant-based rehydration drinks. They offer naturally occurring electrolytes.
The electrolytes.
Right. And that positions them as a perceived superior alternative to, say, sugary sports drinks or heavily processed sodas. It makes them incredibly popular with athletes, fitness enthusiasts, but also just the general health-conscious consumer base. It's seen as a clean label product, natural.
And the market data, I mean, it isn't just suggesting a little bit of growth here, is it? The forecasts look pretty explosive for the coming years.
The forecast is phenomenal, frankly. The global coconut water market alone is projected to grow at an impressive compound annual growth rate, that's CAGR, of 17.1% between 2021 and 2027.
17.1% CAGR.
Wow. Yeah, this isn't just, incremental growth year on year. This is looking like market transformation. And it gives PLUS this massive external driver, just pushing their core product category forward.
Okay, now here's where, for me, it gets really interesting, the quality distinction. Why is Thai coconut product considered superior? And how does that give a company like PLUS a competitive moat and advantage?
Right. This is crucial. Thailand's unique geography, the climate, the soil, combined with its agricultural practices, it seems to provide a distinct advantage. Source material highlights that Thai coconuts possess a unique taste profile. It's often described as slightly sweeter, maybe more fragrant compared to coconuts from, say, Indonesia or the Philippines.
Okay, a noticeable difference.
Apparently so. And crucially, the global market recognizes this quality. The result is that Thai coconut products often get categorized as premium goods. So when consumers in the US or Europe are choosing products on the shelf, they often actively seek out the Thai origin. This reinforces the idea that companies like PLUS can potentially command a higher price point.
So Thailand isn't just competing on volume, it's competing on perceived quality. And the export stats, they back that up in terms of value, not just quantity.
Absolutely. That's the key distinction. While Thailand might not be the largest producer by sheer volume, when you rank countries by the value of their coconut exports, Thailand was the second largest globally back in 2020.
Second largest by value.
Yep, capturing 27.7% of the total market share by value, only trailing Indonesia. That 27.7% market share by value really proves the premium status and the global acceptance of Thai coconut quality, and allows companies like PLUS to leverage potentially a higher price point than some of their regional rivals.
Okay, so moving from the market structure and that quality advantage to the actual results on the ground. Let's see how PLUS has translated this megatrend and their positioning into historical financial performance. This is really essential context for benchmarking TTC later on.
Right. And the net profit story for PLUS, looking back, it's pretty spectacular. From 2018 to 2021, PLUS achieved a substantial 308.2% CAGR in net profit.
308% compounded annual growth in net profit over 4 years.
Yeah. That level of compounding profit growth, it just demonstrates rapid scaling and, frankly, some operational mastery in navigating what were pretty complex global conditions during that period.
And what were those global conditions? I mean, we had massive disruption from the pandemic starting in 2020. How did PLUS fare during that initial phase?
Remarkably well, actually. Counterintuitively, perhaps. In 2020, their revenue actually grew by 23.7%.
Grew during the start of the pandemic.
Yep. The pandemic, it seems, drove demand for their specific products, with people suddenly very focused on health, functional drinks, and also stockpiling staples. U.S. customers, in particular, significantly increased their orders for coconut water. They seem to view it as a sort of healthy pantry item.
Okay, that makes sense. But then looking at the next year, 2021, it looks like the wheels sort of fell off the revenue line, even if you're saying the underlying demand was still strong. What happened?
Yeah, that's the complex layer of the story. In 2021, revenue did dip by 9%. And this is critical, this drop was almost entirely due to external logistical problems. It was not a demand failure.
Logistics. The shipping nightmare of 2021.
Precisely. Customers were placing orders, demand was there, but the world was facing this severe shortage of container ships, compounded by absolutely soaring freight costs. And since PLUS is OEM, customers were largely responsible for securing the shipping lines themselves.
Right, under the OEM model.
When they couldn't secure the ships, PLUS couldn't physically ship the finished goods out the door. That directly led to lower recorded revenue for PLUS, even though the orders might have been there.
Okay, so that makes the 2021 dip seem more temporary, assuming global logistics eventually recover. It suggests there might have been massive pent-up demand just waiting to be released once the supply chain started moving again.
Exactly right. And that the expectation of logistical normalization, that's really what underpins the strong financial forecasts we see for PLUS in 2022 and beyond. They're betting on that recovery. Hashtag 2.2, analyzing profitability and cost management, GPM.
Let's shift to efficiency then. Gross profit margin, GPM. It's kind of the ultimate measure of how well a manufacturer controls its production costs and manages its pricing power. What does the GPM trajectory look like for PLUS during this period?
This is arguably the most fundamental strength shining through in the PLUS data. Their GPM showed continuous, really systematic improvement. It started at 15.5% back in 2018 and rose steeply, consistently, all the way to 27.3% by 2021.
From 15.5% to 27.3% GPM in 4 years. That's nearly doubling the gross margin. That's a rare accomplishment, especially in high-volume manufacturing.
It really is. And that GPM jump, it wasn't just luck or riding the coconut wave. The sources clearly identify 3 main pillars behind this margin expansion.
Okay, what are they?
First, economies of scale. This was achieved through increasing their capacity utilization. It's not just about producing more bottles, it's about optimizing the entire production line.
How so? Like less waste?
Exactly. Reducing waste percentage, maximizing the efficiency of processes like sterilization, packaging. All of that dramatically drops the fixed cost per unit as volume goes up.
Okay, economy of scale. What's the second pillar?
Second was a strategic shift in their product mix. Even within the OEM business, they consciously focused their sales efforts on their higher margin offerings. Not all OEM contracts are created equal.
Got it. Pushing the more profitable SKUs. And third?
Third was implementing strict cost-saving measures continuously across the entire operation. This suggests more than just a one-off project. It points to a deeply ingrained culture of efficiency, always looking to trim fat. Okay, this mastery of costs, it leads then to what the report calls the big jump forecast for the following year, 2022. What were the specific numbers projected there?
Yeah, the forecast was very bullish. Normalized profit for 2022 was forecasted to grow sharply by plus 49.2% year over year, hitting around 151 million baht. This projection was clearly assuming those logistical constraints would ease up, allowing them to capitalize on that previously suppressed demand we talked about.
Right. And the GPM itself, was it expected to stabilize at that higher level, around 27-28%?
Yes, exactly. It was projected to increase slightly further to 28.1% in 2022, and then sort of stabilize right around 28.5% by 2024. That stability near the 28% mark, if achieved, would confirm that they've likely reached and locked in their peak operational efficiency, putting them really in the upper echelon of profitability for the industry. Okay. And beyond GPM, we also need to look at operating efficiency through the lens of SG&A expenses, selling, general, and administrative costs as a percentage of sales. How did that look?
The SG&A to sales ratio was also projected to improve significantly, dropping to 14.8% in 2022, down from 16.5% in 2021.
What drove that improvement? Just cost cutting.
A significant portion of that specific improvement actually came from removing some one-time write-downs that had impacted the 2021 financial statement. So by normalizing the SG&A, stripping out those one-offs, the company's underlying operating margins were expected to stabilize robustly above 10%.
Above 10% operating margin.
Yeah, which basically means for every dollar in revenue they bring in, over 10 cents is converting directly into operating profit before they even account for interest and taxes. That's pretty healthy. Hashtag TACC 2.3, managing input costs and price fluctuation.
All right, now for what can often be the Achilles heel of any manufacturer dealing with agricultural products, raw material volatility. Coconut prices, I assume, can swing pretty wildly depending on harvest and weather. How does PLUS manage this risk?
They have a major advantage here, and it's anchored in geography. Their main factory is strategically located in Samut Songkhram province.
Okay.
And Samut Songkhram happens to be the 5th largest coconut-producing province in Thailand. But crucially, the local supply, the coconut output in Samut Songkhram, is historically exceptionally stable.
Stable how? Compared to other regions?
Very stable. Over an 8-year period analyzed in the source, this province experienced only a 1.2% average annual output change in coconut production.
Only 1.2% variation.
Yeah. Compare that to the national average changes, which fluctuate more like 4% to 6% annually. It means their local sourcing risk, the risk of a sudden shortage or price spike right where their factory is significantly minimized compared to competitors who might rely on sourcing from more volatile regions.
Okay, that 1.2% stability, that's huge. It acts like a buffer. But national or even global factors could still spike prices overall, right? So what happens then?
Exactly. That local stability acts as a geographic buffer, but it's not foolproof against broader market moves. So when national or global prices do spike, the company relies on a critical financial mechanism in their contracts: cost plus pricing.
Cost plus pricing. How does that actually work with their big international OEM customers? Can they really just pass on increases?
Well, this policy allows PLUS to pre-negotiate terms within their contracts that permit price adjustments to the customer based on specific prevailing factors, namely changes in exchange rates, the volume of the order, and also considering their competitive position in the market at that time. Essentially, yes, they aim to pass on significant input cost increases where feasible under the contract terms.
Okay, but let me play devil's advocate here on that cost plus model. You said earlier that Thai coconuts are seen as premium. Isn't there a ceiling on how much they can actually pass along in price increases before a major U.S. buyer just says, you know what, this is getting too expensive, let's switch to a lower cost supplier, maybe from Indonesia or Vietnam, even if the quality isn't quite the same?
That's the absolute tightrope they have to walk. It's the precise balance they must strike. The sources suggest that because Thai products already hold that premium perception sought after for taste and quality, there is sufficient brand equity, or perhaps quality loyalty, to accommodate reasonable price adjustments. The idea is the customers aren't just buying generic coconut water, they're specifically buying Thai coconut water.
So the Thai origin itself gives them some pricing power.
That seems to be the argument, and we have specific data showing the cost if this mechanism fails.
Right. What does that look like?
The sensitivity analysis is crystal clear. If PLUS were unable to use its cost-plus policy effectively, a hypothetical 10% rise in raw coconut prices would directly erode their GPM by 1.3 percentage points. That's significant. And even more dramatically, it would slash their net profit by a hefty 9.4%.
Wow, almost 10% off the bottom line just from a 10% coconut price hike.
Exactly. So the effectiveness of that cost-plus policy is absolutely central to them maintaining that impressive targeted 28% normalized GPM and achieving stable profitability year after year. It's not just a policy, it's a core risk management tool.
Okay, so we've established the operational excellence, the cost control at PSUS. Now we need to address the main structural risk that's often shared by many high-volume manufacturers, and it's definitely relevant when we think about TCC later: customer concentration.
Yes, this is a significant point of vulnerability for PLUS, even despite their global sales footprint. The risk exposure stems from a heavy reliance on a single major customer.
Who is that?
It's a company called RP Foods LLC, which operates as their main distributor in that crucial U.S. market we talked about.
RP Foods in the U.S. Okay, how concentrated is the revenue stream coming just from them?
Highly concentrated. According to the data for the first 9 months of 2021, RP Foods LLC accounted for 30.4% of PLUS's total sales.
30%. Almost a third of all sales.
Yeah. And what's perhaps more concerning is that figure had actually grown from 27.2% in the full year 2020. So it indicates a deepening reliance on this one single partner, at least during that period.
Okay, so roughly 1/3 of their entire global business depends on the financial health, the strategic decisions, the continued order volume just of this one distributor. What's the practical downside if that relationship sours for any reason?
Well, the downside is potentially catastrophic. If that customer, RP Foods, decided to significantly slow down orders or cancel contracts, or maybe if they got acquired by a competitor with different sourcing plans, it would mean the immediate disappearance of nearly 1/3 of PLUS's revenue.
Oof.
Yeah, that would fundamentally destabilize the company's results overnight and jeopardize their factory capacity utilization, potentially undoing all those efficiency gains. This kind of structural risk, it absolutely mandates the strong diversification strategies that they are actively pursuing. They have to address this.
Right. Which brings us neatly to their proactive mitigation efforts. Let's start with developing their own proprietary brands, that 8% slice we mentioned earlier.
Yes, this is the key strategic pivot designed to achieve two things: capture higher margins for themselves and reduce that dangerous reliance on a few large OEM customers. They're actively pushing their own brands like Coco Royal and Nita. And the source mentions an ambitious goal: launching at least 2 new branded products every year.
2 new branded products annually. That sounds like a significant shift in focus. It's not just B2B manufacturing anymore. That requires real consumer marketing muscle, doesn't it?
Absolutely. It requires a fundamental shift in thinking and potentially in capital expenditure. You need resources for packaging design, building marketing budgets, fighting for shelf space internationally, managing inventory risk for finished consumer goods.
Yeah.
It's a different ballgame.
But the strategic benefit, if they pull it off, is massive.
Right? Huge. Own brands typically command higher prices and deliver much higher gross margins. It also allows them to utilize their factory capacity more on their own terms, producing what they want to sell, which can boost overall profitability significantly.
Okay, so own brands is one diversification plank. The second seems to be continuous geographical expansion, trying to dilute the risk coming just from the U.S. market.
Absolutely. That's the other side of the coin. They are continuously working to penetrate new international markets. That means moving deeper into China, expanding their footprint in Europe, focusing more on opportunities in the Middle East, and securing distribution footholds in those neighboring CLMV countries.
Spreading the bets geographically.
Exactly. The ultimate goal is to ensure that no single country, and therefore likely no single distributor within a country, dominates their revenue composition quite so heavily in the long term.
Makes sense. And they're also investing in research and development, R&D, to try and differentiate themselves even further. What new frontiers are they exploring there? Is it just more coconut flavors?
No, R&D seems focused on creating truly unique products, moving beyond just coconut to provide genuine differentiation in the broader health beverage category. A key new focus mentioned is the development of various plant-based drinks that are specifically non-coconut based.
Ah, okay. Moving beyond coconut.
Yeah, and this is a very smart strategic move, isn't it? It offers a kind of hedging mechanism against potential saturation in the coconut market, or unforeseen issues like disease in the coconut supply chain. Plus, it allows them to tap into the explosive growth we're seeing in the overall global plant-based food and drink market, which is even broader than just coconut water. Hashtag TACC 3.3, mitigating external risks, FX and logistics.
Okay, let's shift gears slightly to macroeconomic risks. These must be huge when, as you said, 98.5% of your revenue is coming from international sales. Foreign exchange, or FX exposure, must be right at the top of the list.
It absolutely is. The data showed roughly 62% of their revenue was denominated in US dollars and another 5% in Chinese yuan. But the vast majority of their operating costs, paying for coconuts, factory labor, utilities in Thailand, those are in Thai baht. So fluctuations in the baht against those currencies are a substantial risk vector.
Right. What is the sensitivity? Does the source quantify how much their profit moves if the baht strengthens, which is generally bad for exporters?
It does. The source material provides a pretty stark sensitivity figure. It estimates that if the Thai baht were to strengthen by just 1 baht against the US dollar, it could negatively impact the company's net profit by as much as 12.5%.
12.5% hit to the bottom line from just a 1 baht move in the exchange rate. That is a massive potential reduction. It really highlights the vulnerability inherent in being primarily a USD receiving exporter based in Thailand.
It does. So how are they demonstrating robust financial risk management against this constant FX volatility? What's the plan?
Their policy, according to the source, is to actively hedge this exposure. They utilize forward contracts.
Okay, standard practice for exporters.
Standard but essential. It allows them to lock in exchange rates for future transactions, effectively fixing the Thai baht value of their anticipated USD receipts months in advance. The report notes that even during periods when the baht was appreciating back in 2018-2019, they managed to protect their baht-denominated revenue streams reasonably well and still achieve double-digit growth. So it demonstrates the effectiveness of this hedging policy in providing some stability.
Okay, so they're managing the FX risk proactively. What about those logistical headaches we saw impacting them in 2021? The container shortages, the sky-high freight costs that hamper their delivery volumes, is that risk truly behind them now, according to the forecasts?
Well, the assumption built into those strong 2022 and 2023 financial forecasts we discussed is that, yes, the worst of that crisis is indeed over. The general consensus reflected in the analysis is that while international shipping probably remains expensive compared to pre-pandemic levels, the acute operational crisis, the part where customers literally could not secure container lines at almost any price, is normalizing.
Okay, normalizing, not necessarily cheap again.
Exactly. This anticipated easing is what allows the models to project that suppressed volumes can resume their growth trajectory. But, logistics risk absolutely remains a factor they have to monitor closely. Unexpected geopolitical events, port strikes, fuel price spikes, these can still disrupt global shipping lanes very quickly. It's an ongoing risk, just maybe less acute than it was in 2021.
Okay, so we've covered performance, risks, mitigation. Now let's examine some of the qualitative factors, the strengths that PLUS seems to control internally on the factory floor and in their strategy that support their future growth prospects. Hashtag TACC 4.1 production capacity and future expansion.
Right. Let's look first at their current production capabilities. Do they actually have sufficient capacity already built to handle that projected, 13% CAGR in profit over the next few years? Or do they need to spend big on a new factory tomorrow?
This is a major operational strength for them right now. Yes, they appear to have ample spare capacity. Their current full capacity is stated at 197.8 million bottles per year.
Okay, almost 200 million bottles.
But in 2021, their actual utilization rate was only 52.2%.
Only 52%, so almost half the factory was idle.
Essentially, yes. It means they have almost half their existing factory infrastructure sitting ready, capable of absorbing that forecasted growth through 2024, potentially even beyond. They can achieve rapid volume increases without the immediate disruptive cost and the lead time of building a whole new plant.
Okay, that available capacity is effectively like a built-in growth runway for the next few years. That's a great position to be in. However, despite that, they are still planning a major new investment, aren't they? What's the rationale behind that if they have spare capacity?
Yes, they are. And it signals they're strategically planning for long-term growth beyond the current 2-3 year forecast horizon. They are reported to be cautiously considering a significant investment, around 200 million baht, for a new aseptic production line. And this line is specifically designed for PET plastic bottles.
PET plastic. Why PET specifically? That must be a deliberate choice over, say, glass or the existing rigid packaging they might use.
It likely is. PET, or polyethylene terephthalate, offers several advantages. It allows for lighter shipments, which can help reduce those sensitive freight costs further down the line. It's also increasingly the preferred modern packaging format. In many key global markets, easier to handle, less breakable, convenient for on-the-go consumption.
Makes sense. And how much capacity would this new line add?
This new PET line would add an estimated 76.6 million bottles per year to their total capacity. The very fact that management is seriously planning this substantial 200 million baht investment, even with current spare capacity, it really signals strong confidence from them in securing continued international growth well into the late 2020s. They're looking further ahead, hashtag TACC 4.2 ESG initiative cost saving, and alongside planning for capacity expansion, they're also tackling sustainability and cost control simultaneously. There's an interesting ESG initiative mentioned focused specifically on energy.
Environmental social governance. Tell us about the solar investment they're making.
They're investing 35.3 million baht to install a 1 megawatt solar rooftop system right there at the Samut Songkram factory. This looks like a textbook example of using a green initiative to achieve tangible cost control.
Okay, 1 MW solar rooftop. What's the expected bottom line impact from that? How does it help them?
Two main benefits are highlighted. First, the direct cost saving. They expect it to reduce their electricity costs from the grid by about 30%. That is a direct and likely permanent boost to their operating margin, and it also protects them somewhat from volatile energy prices in Thailand.
30% off the electricity bill. Okay. What's the second benefit?
Second, and this is really crucial for a high-volume, continuous manufacturing operation, it provides operational resilience. The solar power offers protection against local power outages or brownouts during daylight hours. This minimizes the risk of costly production downtime and helps ensure they can maintain consistent fulfillment of those important international orders. Reliability is key for OEM. Hashtag TACC 4.3 product differentiation and quality standards.
Absolutely. Okay, you can't be a premium global exporter, especially in food and beverage, without absolutely rock-solid quality control and certifications. What are the key certifications mentioned that essentially act as their passport, their gateway to these diverse global markets?
Yeah, quality certification is completely non-negotiable in this business. They maintain a comprehensive suite of rigorous international standards. The list includes HACCP, GMP, FSSC 22000. And critically, they have U.S. FDA registration, which is essential for that huge American market. They also hold HL certification, which is crucial for accessing markets in the Middle East and specific Muslim consumer segments in Asia and elsewhere.
Right. Maintaining all of those standards must be expensive and time-consuming, but absolutely necessary.
Essential gatekeepers. They're required to serve diverse international regulatory environments and meet different dietary requirements across multiple continents.
Yeah.
You just can't play in this space without them.
And the product portfolio itself needs to be pretty vast and adaptable to cater to all these different cultural tastes and preferences, right? It can't just be one-size-fits-all coconut water.
Absolutely not. And this is highlighted as a core qualitative differentiator for PLUS. They tailor their offerings significantly based on the target market. For example, the source mentions they offer 6 distinct coconut water formulas, perhaps tailored for different sugar levels, calorie counts, or added ingredients.
6 formulas just for coconut water.
Yeah. Then they produce 17 different coconut milk drink flavors. These are apparently hugely popular in Latin American markets, where consumers often prefer a creamier texture in their beverages.
Okay, 17 coconut milk flavors. What else?
And then, perhaps surprisingly for some, they offer 21 different basil seed and chia seed drink flavors. These are particularly targeted towards the Middle East, tapping into a unique regional preference for drinks with added texture and perceived nutritional value from the seeds.
21 seed drink flavors. Wow. Okay, this ability to customize and cater so specifically to different continental tastes, that must be a huge factor in securing and, importantly, retaining those big OEM contracts you mentioned earlier.
You'd have to think so.
Yeah.
It transforms them from being just a simple contract manufacturer into more of a specialized product development partner for their clients. And this ties right back to their overall competitive strategy we discussed. That commitment to high quality, constant differentiation through this wide portfolio and underpinning it all with a cost-plus pricing model. It means they are explicitly choosing to compete on value and uniqueness, not just trying to be the cheapest producer on the block.
Right. Stay out of the race to the bottom on price.
Exactly. Which is essential for maintaining those stable, high margins in the fiercely competitive global beverage arena.
Okay, so we've established the strong operational fundamentals, the risk management, the quality focus of PLUS. Now let's look at their financial health picture, especially focusing on how their balance sheet was expected to transform following their initial public offering, their IPO.
Right. The IPO was clearly a watershed moment for their financial stability, primarily because a significant portion of the funds raised was earmarked specifically to pay down existing bank loans, and the resulting projected improvement in their debt profile is pretty remarkable.
All right, let's start with the key debt metric, the debt to equity, or DE ratio. What did that debt structure look like before and after the IPO impact was factored in?
The change was dramatic. The DE ratio was forecasted to drop sharply from 1.01x at the end of 2021, which means they had slightly more debt than equity on their books.
Okay, about 1-to-1.
Right. Down to a projected highly conservative 0.22x in the 2022 estimates. Similarly, another key metric, the interest-bearing debt-to-equity IBDE ratio, which focuses just on debt that accrues interest, that was projected to fall from 0.36x down to a very low 0.08x.
Okay, so in real terms, they basically shifted almost entirely away from reliance on expensive bank financing. They became much more financially independent. That must free up significant cash flow, right?
Exactly. Instead of cash flow going out the door to service heavy debt payments, it becomes available for things like operations, investment, or paying dividends to shareholders, which reinforces stability and investor confidence. And this shift also dramatically improves their short-term liquidity position, which we can measure using the current ratio.
Right, the current ratio. I recall the source mentioning that had previously been a bit weak for PLUS. What was the expected leap in their short-term liquidity post-IPO?
Yeah, between 2018 and 2021, their current ratio, which basically measures their ability to cover short-term liabilities with their short-term assets like cash and inventory, was consistently below 1.0x. That's often seen as a sign of potential cash flow strain.
Below 1.0x is tight.
Very tight. But post-IPO and after using the proceeds for debt repayment, the current ratio is expected to increase significantly, projected to reach 3.56x in the 2022 estimates.
Wow, a jump from below 1.0x all the way up to 3.56x. That's huge. For the listener, what does that level of liquidity, a current ratio over 3, actually mean for the company's day-to-day operations?
It signals exceptional financial flexibility. They're no longer operating under the daily stress of a potential cash crunch. It means they can likely negotiate better payment terms with their own suppliers, they can confidently manage their working capital cycles, like holding inventory, and they can potentially take advantage of unexpected market opportunities because they're holding a significant cushion of liquid assets relative to their immediate liabilities. It's a much safer position.
Definitely. Okay, finally on financial health, let's look at return on equity, or ROE. This often takes a temporary dip right after an IPO because the E part, the equity base, suddenly gets much larger from the new shares issued. Was that expected here?
Yes, that's exactly what the projection showed. The ROE was projected to temporarily decrease to 15% in 2022, down from a very high 23.7% in 2021. But as you said, this isn't typically seen as a sign of operational failure. It's purely a mathematical result of the equity base, the denominator in the ROE calculation growing significantly larger immediately post-IPO.
So the profitability engine is still strong, just spread over more equity.
Precisely. And importantly, the ROE was still projected to stabilize strongly around 15.6% to 16.1% in the following years, 2023-2024. So it remains a solid, healthy double-digit figure that reflects their underlying high operational efficiency, even with a larger capital base. Hashtag TACC 5.2 key valuation metrics in peer comparison.
Okay, this deep dive into PLOS now sets the stage perfectly to finally benchmark TACC. Both PLOS and TACC operate in this high-growth Thai beverage sector, so analysts often group them together for valuation comparisons. What was the consensus target price and the valuation basis mentioned for PLOS in the source?
The consensus target price identified for PLOS back in 2022 was assessed at 5.3 bait, and this target price was explicitly based on applying a relative price to earnings, or PE ratio, specifically using the normalized PE of 23 times.
23 times earnings. Okay, why 23x? That feels like quite a premium multiple for a manufacturer.
It is a premium, and that 23x multiple was derived directly from looking at the average historical PE trading range, typically between 20x to 25x earnings of similar listed beverage companies right here in Thailand. And the key comparable peers mentioned explicitly include IACHI, SAPE, and critically for our discussion today, TCC itself.
Ah, okay, so TACC's own high valuation is part of the justification for applying a high multiple to PLUS. Investors seem to apply this premium to this whole group of stocks. Why? What characteristics do they share?
Generally, it's because these companies consistently demonstrate or are perceived to have the potential for aggressive growth. They often boast high profit margins compared to other sectors, and they frequently have proprietary scalable distribution advantages, whether that's export networks like PLUS or domestic dominance like TACC. The market pays up for that predictable growth and high returns.
Okay, so TCC's own valuation metrics are being used in part to set the benchmark price for its peer, PLUS. Now, if we look at PLUS's own 2022 financial projections at the time, was it actually trading at a discount to that 23x target multiple?
Yes, according to the analysis. Based on those 2022 normalized profit projections, PLUS was anticipated to be trading at a normalized PE ratio of around 19.9x.
19.9x versus a target of 23x.
Right, which suggested that the stock at that point was potentially trading at a noticeable discount compared to the sector's target multiple. It implied potential upside for PLUS's share price if the market fully recognized its recovered growth momentum and its newly improved balance sheet post-IPO.
Okay, let's just quickly summarize the investment case for PLUS as a growth stock based on this data before we pivot fully to TACC.
Sure. The core projection suggested robust growth was set to continue, fueled by those external megatrends in health and coconut demand, combined with their proven internal efficiency. The forecast pointed to an estimated normal profits TGR of around 13% over the next 3 years, from 2022 to 2024.
Solid growth outlook.
Yeah, so based on that snapshot, PLUS looked like a compelling growth stock, potentially trading below its sector average multiple, and importantly, underpinned by strong operational efficiency and a much more conservative financial profile after the IPO.
Perfect. We've meticulously established the operational floor for the sector using TACC. They thrive by maximizing OEM efficiency, leveraging that made in Thailand quality for premium pricing internationally, and maintaining impressive financial stability, especially post-IPO. Now, finally, we shift our full attention back to TCC. We'll use all those P+US metrics and insights as our comparative lens. And crucially, we need to specifically analyze the 5 key points that were outlined right at the start for TCC.
Yes, and the comparison is powerful, I think, because both companies, despite their different markets, share that single greatest structural risk we identified, a heavy reliance on one primary customer relationship.
Right.
For PLUS, as we saw, it's that one major U.S. distributor, RP Foods LLC, accounting for about 30% of sales. For TCC, the concentration is arguably even more profound. It's the reliance on one massive domestic retailer network, 7-Eleven. TCC's entire strategy, it seems, revolves around optimizing that crucial partnership, while simultaneously and perhaps desperately trying to diversify away from it to mitigate that risk. #TACC 6.1 Performance and Profitability, TCC Q368.
Okay, point 1 for TCC. Performance and profitability, specifically focusing on the outlet for Q368. Based on the forward-looking news and analysis mentioned in our prompt, what's driving TCC's profit picture for that quarter?
The forward-looking analysis indicates potentially exceptional performance for TCC. One specific headline highlighted points directly to TCC's profit, possibly surging by a massive 49% year-over-year in Q368.
49% profit growth in a single quarter.
Yeah, an incredible number. And the analysis attributes this projected boost directly to the strength of sales within 7-Eleven. Furthermore, looking at the bigger picture, the annual net profit forecast for the full year 2068, which corresponds to 2025, is targeted at 297 million baht. That represents a projected 20% growth from the previous year, based on total revenue forecasted to reach 2.224 billion baht.
Okay, a 49% profit surge in Q3, even leading into 20% growth for the full year. That absolutely confirms that the operational performance of their core business, those beverage dispensing machines inside 7-Eleven, is incredibly robust and highly profitable right now.
Absolutely. The main driver is the sheer strength and symbiosis of that partnership. TSC's works constantly, hand in glove with 7-Eleven, to develop new core menu items for their machines, and also those frequent new menu promotions and seasonal specials. This ensures they maintain relevance and excitement within that highly frequented all-cafe, non-coffee beverage line inside the stores.
So unlike PLOS, where margins are constantly battling things like international freight costs and FX rates, TCC benefits from this captive, high-turnover domestic distribution system. Does that translate to higher margins for TSC compared to PLOS?
Yes. Generally speaking, TSCC's model allows for remarkably stable and high profitability. While PLOS's GPM was impressive, around 28%, TCC's net profit margin is projected to be very high. The prompt context suggests around 18.2% net margin was projected back in 2023, and its return on equity, ROE, is projected even higher than PLOS's normalized level, potentially reaching a very strong 33.5%.
Okay, an 18% net margin and over 33% ROE. That level of profitability certainly explains why TACC consistently sits at the high end of that 20x to 25x sector valuation benchmark we discussed earlier when looking at PLUS's peers. The market clearly rewards that predictability and return. #TACC 6.2 non-drink growth strategy and diversification.
Exactly. And that high profitability flowing from the core 7-Eleven business is what provides TSCC with the necessary cash flow, the war chest, to aggressively address its concentration risk through diversification, particularly, as point 2 highlights, into non-drink businesses.
Right. The critique in the prompt noted this section often lacks depth and typical analyses, so let's try to elaborate. What specific non-drink segments is TSC actively pursuing? And what's the overarching strategic aim behind this diversification?
They are actively moving into several areas. Character licensing is one, leveraging popular characters on various products. They're also pushing into cosmetics and potentially other consumer products that can be sold both inside and outside of 7-Eleven.
Okay, character goods, cosmetics. What's the strategic goal? Is it just finding new revenue?
The strategic aim seems to be twofold. First, yes, it's about leveraging the immense brand recognition and, more importantly, the physical foot traffic of the 7-Eleven network to sell more than just beverages. Can they use that access to launch other products effectively? Second, and perhaps more crucially long-term, it's about building entirely new revenue streams that are fundamentally disconnected from the day-to-day pressures of the beverage market, things like weather patterns affecting cold drink sales or intense price competition from other drink brands.
Right, creating revenue streams with different drivers. Does the source material quantify what proportion of TTC's total revenue currently comes from this non-drink segment? Is it significant yet?
The prompt context doesn't give a specific percentage, which likely implies it is still relatively small compared to that huge 2.2 billion baht core beverage revenue stream from 7-Eleven. However, TTC's management has explicitly stated their commitment to aggressively pushing total company revenue well past the 2 billion baht mark. And importantly, they've signaled that this expansion will be pursued not just organically, but potentially faster via mergers and acquisitions, M&A, and strategic joint ventures, JV.
M&A and JVs. That suggests they might view acquiring existing businesses as a faster way to gain expertise and market share in these new non-drink categories rather than trying to build everything from scratch internally.
Precisely. It indicates a serious commitment and potentially a faster timeline for this diversification. And this diversification strategy, it's fundamentally different from PLUS's approach, isn't it? PLUS is diversifying by launching its own branded beverages internationally. TACC seems to be looking for entirely new consumer product verticals.
That's a key distinction, yeah. PLUS is sort of deepening its vertical specialization in beverages, but moving up the value chain towards higher margin brands within that field. TCC, on the other hand, appears to be aggressively diversifying horizontally, spreading across different types of consumer goods, and using the substantial cash generated from their core beverage dominance to fund this strategic restructuring. It really demonstrates a genuine ambition to become a broader consumer goods holding company, not just a beverage dispenser operator. Hashtag TACC 6.3 Risk and Diversification Plan.
Which brings us to point 3, explicitly analyzing the risk from relying on that major customer, 7-Eleven, and the plan to mitigate it. We've touched on this, but let's focus. Both companies, PLUS and TLUSC, clearly recognize customer concentration as their single biggest strategic threat. If PLUS is mitigating its U.S. distributor risk by expanding its own brands into new international markets, how exactly does TLCC mitigate its massive 7-Eleven concentration risk?
It seems TACC's mitigation plan has to be, almost by definition, a mirror image of PLUS's approach. They absolutely must develop strong B2B, business to business, and B2C, business to consumer, sales channels outside of the 7-Eleven ecosystem entirely.
Right, that has to be the goal.
This means actively expanding their own brands, whether it's their cosmetic lines, the products using those character licenses, maybe even future acquisitions into other retail channels. Think supermarkets, hypermarkets, maybe even their own direct-to-consumer e-commerce. And also pursuing international exports for these non-7-Eleven products. Essentially, they need to create truly alternative revenue streams that are not directly reliant on the contractual terms or sales metrics dictated by their primary partner.
So the diversification strategy isn't just about selling different things within 7-Eleven. It's about selling things outside of 7-Eleven altogether.
Exactly. It's designed to make TACC as a whole company less susceptible to any sudden change in 7-Eleven's strategic priorities, or maybe changes to 7-Eleven's internal operational costs that might lead them to squeeze supplier margins, impacting TACC's contractual terms down the line. They're trying to build a genuine risk buffer by establishing completely new distribution partnerships and customer bases, both domestically in Thailand and, ideally, internationally as well. Hashtag TACC 6.4 technical view and valuation.
Okay, let's revisit the valuation metrics then, point 4. We already established that TCC itself is used as a key peer to justify the sector's high benchmark valuation, that 23x normalized PE multiple we saw applied to PLUS.
Yeah.
What does this high valuation consistently awarded to TCC tell us about the market's perception of its stability and its growth prospects?
It tells us the market places a very high premium on TACC's specific business model. While PLUS might be valued primarily on the strength of its operational efficiency and its access to global export megatrends, TACC seems to be valued more on the perceived strength and predictability of its strategic partnership with 7-Eleven and the consistent cash flow that generates.
Predictability commands a premium.
It often does. The fact that the sector average for forward PE ratios mentioned in the prompt context is high, around 24.2x was cited for 2023, it just confirms that investors are currently willing to pay up significantly for companies in this space that demonstrate consistent high growth, like TACC's projected 20% profit growth, boast very high margins, like TACC's potential 18.2% net margin, and deliver exceptional return on equity, like TACC's potential 33.5% ROE.
So if TACC is genuinely generating that kind of strong profitability and achieving such a high ROE, then from a growth investor's perspective, that premium valuation might feel entirely justified, even if it looks expensive on a simple PE basis compared to the broader market. What about other valuation aspects like liquidity or dividends?
Well, while TACC's balance sheet structure might differ from PlayEllis's, especially after PlayEllis used its IPO funds to slash debt, TACC's consistent high profitability should ensure very strong internal cash generation. We saw a strong projected dividend yield mentioned for the sector. PlayEllis was forecast at 4.4%. TACC's dividend policy has historically tended to be quite generous, precisely because of its stable and predictable cash flow from the 7-Eleven business. This high dividend payout often further cements its appeal to certain investors, helping to support the valuation despite the high PE ratio.
Right, the dividend yield provides some support. And the consensus target price for TACC.
The prompt asks for the average target price, consensus. While we don't have the exact number from this specific source, given the high peer multiples and TACC's strong performance metrics, it's safe to assume the consensus target price remains high, reflecting ongoing market confidence in its aggressive growth trajectory, both core and diversified.
Okay, finally, point 5, the qualitative analysis. What is TACC's ultimate qualitative strength? Its operational moat. For PLUS, we identified things like the stable sourcing location and their premium Thai coconut quality. What's the equivalent for TACC? It's clearly not a factory location.
No, TACC's moat isn't on a farm or in a specific province. It's the infrastructure investment within the thousands of 7-Eleven stores across Thailand, specifically those beverage dispensing machines.
Ah, the physical footprint inside the stores.
Exactly. The ongoing success of their core business, the 7 Select cold drinks, the all-cafe non-coffee beverages hinges entirely on the continued expansion, the meticulous maintenance, and probably the technological upgrading of that physical dispensing machine footprint within that vast, dominant 7-Eleven store network.
Why is this machine footprint so critically important as a qualitative growth factor, as a moat?
Because it represents a massive physical barrier to entry for any potential competitor wanting to sell similar dispensed beverages inside 7-Eleven. The NCC has secured not just the product supply contract, but also the physical real estate on the counter and the operational agreement to be the exclusive or primary supplier for these specific types of drinks within the country's dominant convenience store chain. They manage the whole thing. The logistics of supplying the syrups and cups, the product development, and crucially, the machine installation and maintenance.
So a competitor can't easily just walk in and put their own machine next to TACC's.
Highly unlikely. And TACC's sustained focus, mentioned in the performance section, on constantly developing new products for these machines, like yogurt-flavored drinks or seasonal specials, it just confirms their belief that this captive distribution system is a reliable, highly differentiated engine for driving sales volume. It allows them to achieve continuous product innovation right there at the point of sale, without needing the huge marketing spend that's typically required to launch and support shelf-stable packaged drinks fighting for supermarket space.
That control over the distribution method itself. That really is TACC's single most powerful qualitative strength, isn't it? It provides a level of day-to-day operational stability that PLUS perhaps seeks through its geographically stable coconut supply chain. Different kinds of stability.
That's a great way to put it. So TACC's operational genius lies in optimizing the supply chain into the 7-Eleven customer via those machines, while PLUS's genius lies in optimizing the supply chain out to the international OEM customer via efficient manufacturing and logistics.
That's a perfect summary, I think, of the core dynamic we've explored using these two companies. Both are clearly mastering efficiency within their chosen operational vertical, and importantly, both are now utilizing the financial strength gained from that efficiency to fund crucial risk diversification strategies, albeit in different directions.
Which leads us right to our final conclusion, tying back to the prompt's main question. Based on all this, is TACC successfully transitioning to a more diverse product portfolio, and is it maintaining its status as a growth stock?
The evidence presented, especially those forward-looking Q368 forecasts, strongly suggests yes on both counts for now. The immediate projections show the core 7-Eleven business remains highly profitable and is potentially even accelerating. This core strength is absolutely essential because it provides the capital and the management confidence needed to pursue that diversification strategy aggressively, whether it's through launching cosmetics, signing character licenses, or undertaking M&A.
So the transition is happening, funded by the core?
Exactly. TACC is clearly serious about mitigating its single customer risk over the long term. This proactive approach, combined with the strong underlying growth, reinforces its position as a high-growth stock within what the market perceives as a highly valued sector. The transition is active, it appears to be well-funded by the core business, and it's strategically essential for TACC's long-term sustainability beyond just the 7-Eleven partnership.
Hashtag TACC patch outro.
So how was that for a comprehensive deep dive? We really dissected the Thai beverage sector's operational and financial blueprint, didn't we? We used the export powerhouse, PLUS, as our essential guide and benchmark. The template.
Yeah, the template, which allowed us, I think, to more accurately benchmark the fundamental strengths, the very real risks, and importantly, the ongoing diversification strategy of TCC. And it helps explain the drivers behind those high Q368 profit forecasts we discussed.
Absolutely. We hope this information helps you, the listener, gain a clearer, more contextual picture of TCC's fundamental strategy and its current financial standing, especially when viewed against best-in-class peers like PLUS. The insights we uncovered into cost control, managing concentration risk, and funding diversification, those are valuable lessons that really apply across the entire manufacturing and consumer goods sector, not just beverages.
Great point. Now, if you have any questions arising from today's discussion, or perhaps you'd like us to analyze a specific stock in a future deep dive, please do let us know. We always appreciate your feedback and suggestions. Finally, please don't forget to follow, like, and share this. It really helps support our team in creating more content like this. Thank you for tuning in.
Thank you. And just before we go, here is a final provocative thought for you to consider, building on our discussion today. Given the strategic importance we noted of Thai coconut products globally, and the strong operational performance demonstrated by PLUS's OEM dominant model, how might the nature of their core businesses influence the future ceiling for their respective profit multiples?
Interesting angle.
Does the immediate profit stability and predictability that TCC enjoys from its captive retail distribution within 7-Eleven inherently warrant a permanently higher valuation multiple than the potential volatility inherent in PLUS's global export logistics and OEM contracts, even if PLUS potentially offers more long-term margin upside through successfully developing its own proprietary international brands? Which model deserves the bigger premium long-term? Something to mull over as you continue your own research into these fascinating companies.